Good afternoon, good evening, wherever you are out in the internet. Once again, we welcome you to another stock review and analysis that is going to be done, presented by myself on behalf of the Learn, Grow, and Invest community, Learn, Grow, and Invest group. For those who don't know me, I'm Chike Verwe. I am the resident analyst for the different companies and different investments that we get into. So today we're basically going to get into the Trans-Jamaica Highway review. But of course, you know that we normally have a few housekeeping matters to go through, and I normally give the outline that we're going to take. So of course, as we are a Bible-based group, as you're aware, we will be doing our prayer normally as we put this meeting towards the covenant of the Almighty. We're also going to give you the overview of how we're going to review the company. So, with that being said, we will get into it shortly right after this. All right, so as we commit this session to the Almighty, we give our prayer. That Almighty Father, we thank you again for allowing us to do this presentation, bringing knowledge and imparting that knowledge to persons who are passionate and interested in investing and learning and wish to learn more on how to analyze companies, investments, etc., and make credible choices in terms of having that elevated knowledge. We thank you again for the founders and the work that they put in. We thank you again for the team that supports them to make this all possible. So as we commit this session to you, we ask for your guidance and your protection in your precious name. Amen. All right. So as we get into it, I'm gonna put the disclaimer for us up in the slide, so we'll get into that. But as you know, the stock review basically carries where we do an overview of the company, and then we do a look at the competition, if the company has competition or industry and the industry that they work in, and then we go through the reports of the financial reports of the company. Now, in our last segment, I did let you all know that we do a change where instead of looking at numbers, it will be better for the team to see it basically in graphical presentation, right? Graphical illustration. So the presentation will be more about graphs than it is about actual numbers. But there's some stuff that will be made that will be pointed out in it. Additionally, too, we're going to look afterwards at how the company performs on the stock market of itself, and that's on the Jamaica Stock Exchange in terms of the price movement, volume, etc. And then if the company has any upcoming news or events, we're going to look on that as well too. So without further ado, I'm going to share my screen and I'm going to be bringing up the presentation that I will be doing for TransJamaica. All right, so I want to just make it bigger. Apologize for that. So basically, from what we know about Trans-Jamaica Highway, and it's as it stands, well, I should say first a disclaimer, apologies. So as you know, all of the information that we're going to discuss here is strictly for educational purposes only, educational and entertainment. So any decisions that you make thereafter, please do consult with your financial advisor to ensure that you are making the right decision about anything that you have seen, that you learn and you wish to act upon, as we are not financial advisors and are not licensed to give any kind of recommendation to buy or sell any securities whatsoever. So, TransJamaica, as most persons would know, TransJamaican Highway, what they pretty much are in terms of the company is that they operate the east to west portion of the highways of Jamaica, and also the other portion, which is the Portmore leg of the highway. So the east to west, basically, they have three legs, is it? So it's the vineyards, the I think there's Old Harbor, there's vineyards, and then there's the final leg, which is Mapen, getting into the Mapen leg. So pretty much picking out from their mission statement in terms of what they are, they have basically 20 years in Jamaica in terms of management of the highways that are under their stead. And their mission is to leverage their experience gained from the concession and the projects to design, build, operate, and maintain infrastructure solutions using global best practices. So prior to TJH, we would note or remember, or it should be known that the highways, or that section of the highway, east to west, was built and being run by a French conglomerate company called Bogues, and then passed over to TJH, which primarily now, in terms of the principles of TJH, the primary holder, and this is very important going forward in the presentation. The primary shareholder of it is called NROC. It's the National Road Operations, and they are basically the primary shareholder. They have the most in terms of shares, 20% of that for TJH, right? So their vision is that they wish to become the most reliable provider of infrastructure solutions in the Caribbean. And we'll see that they have some things going on later on that sticks to that vision in terms of what they're trying to do. So I want to focus on the specifics of their dividend policy that was written into their prospectus. Why do I focus on that specifically? Is because in reviewing the company, I landed on my opinion that based on volume, etc., and what they do and the current investment, this company is supposed to be an income earner for an investor, pretty much. Of course, every company has their capital gains in terms of stock price movement, but based on how this company is structured and based on how things are projecting, and as such, based on how the dividend policy was written from the prospectus, it 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 would favor more the income-based investor looking for consistent dividends being paid out to you. So let's take a look at the dividend policy as you're seeing it. So they basically, this is from the prospectus that was done when they came to market 2020, and they anticipated that the company would pursue the dividend policy whereby they'll pay an annual dividend that will generally be up to the maximum allowable under the Companies Act after making allowances for their working capital to allow the company to grow under the concession and the agreement that they have, and also with the compliance of applicable covenants under the financing agreements, which may bind the company from time to time. Furthermore, the company's projections, and this is the important part, considering three primary cases. So basically, they had explained their different cases, but the part that was most important to me was what they were projecting in terms of how they would pay their dividend going forward. So let's focus on the part that says, based on the projected operating profits, distributable reserves, and cash flows, the company is projecting dividend yields based on the offer price, ranging from an average of 5.3% to 8.7% in the period 2020 to 2025, and then an average of 24.5% to 35.8% thereafter, and an overall average of 18% to 27.8% for the total period of 2020 to 2036. Now, why I say this is important, in my opinion, is because this is now the ability of the income investor to hold TransJamaica to account, basically in terms of if they've invested, is the company performing the way that they have stated in their prospectus, right? In terms of these projections. If yes, then the investor, the income investor, is then on the good side of gaining a very steady, stable, credible return. If no, they have some decisions to make, questions to ask, and some analysis to do to dig in to see one, if it is, if why is this not happening? Two, if this is going to be the case going forward, and if it's viable to stay in there as the third point I would use, right? So again, this part of the outline of the company dictates going forward what we are going to discuss in terms of their financials. Because take note of where the dividends are coming from, the next important thing. You might have seen a lot of the companies that we've done, it's explicit that the dividends normally come out from net profit attributed to shareholders. But in the case of TransJamaica Highway, it's going to come not just from the profit, but it can come from reserves, it can come from cash flows. So there are multiple areas where they can take that money from. And I'm going to actually point that out as well too, in terms of how dividends were done in their year of 2020, how they paid that dividend, because it didn't come out of, from what I was looking at, it didn't come out of the net profit. So I'm gonna illustrate that as well to show you that their dividend payments will not follow the standard trend of of many of the other companies that explicitly say that the dividends are going to come out of their net profit attributed to shareholders. So remember the percentages. It says projection of 5.3 to 8.7 between 2020 to 2025. And then thereafter, it's supposed to be 24%, not 24%. If you get a 24%, 24.5% to 35.8% dividend thereafter, right? Going all the way up to 2036. That's pretty decent, because as I always speak about dividends as an income investor, I want to make sure that my dividend payments are coming out ahead of inflation and possibly ahead of whatever is the current Bank of Jamaica interest rate, policy interest rate. If I'm getting 24%, that's really good. That's just excellent, to be very honest, because without any kind of, as long as the company's performing, without any kind of further, well, the analysis is always required. But you could literally say if they did their performance to this, then you're not exposing yourself to extreme risk if they were to continue, performing as the way, as opposed to going into other companies, other stocks, etc. Right. So moving on. So the dividend policy continues that NROC, as I said, notice the name that comes up. NROC is one of the primary shareholders, anticipates that the company will pursue a dividend policy whereby it shall declare and pay an annual dividend that will be generally be up to maximum allowance. So we went over this already. And moving forward. So with that, we get to the company's balance sheet information. Now, you're going to see the graphs of the other parts in terms of assets, liabilities, etc. But this part is the part that at the end of the day, the ratios of the company, we want to look at in terms of if they actually have the ability to do what they said they're doing. So I skipped over the industry that they're in, and just to quickly touch on that is that this is a unique company to the Jamaica Stock Exchange. Why is that so? There's no other company operating concessions of roads or highways on the Jamaica Stock Exchange. And also the market cap that they have is extremely huge based on that. Now, what is the market cap? Market capitalization, which is the number of shares that they had put out when they came to market. So it's basically one of the larger companies that was brought to market by the government of Jamaica, etc. And as such, it's, as I said, in my opinion, one of those that you have to look on for the long term. Now, for those who know, when I look on my balance sheet and I do my calculations, I look on the ratios of the company. I set thresholds and I put those ratios accordingly to how it is set by my standards to see how the company stands on its own. The glaring thing here is that, yes, TransJamaica has been red for the longest while for all of the information that they have given in terms of their performance for each of the ratios that are highlighted here with respect to debt and also with respect to how they handle cash as well too. So all of their debt ratios are in the red. All of their cash ratios and their current ratios, etc., are also in the red. But there's a consistent theme as well, though, that even though it's red, that I must point out. If you notice and you look on it at least by the numbers, you'll notice that there is a standard trend that they keep everything at a certain threshold. So let's take debt to assets, for instance, and that's the amount of debt that basically makes up assets. They keep it at 0.81, right? You know, it needs to be lower, but the fact of the matter is, it's as on an average of 0.80, 0.81, as you can clearly see going on year to year, year on year. And then the same for the debt to equity, which is the amount of debt that makes up their equity. That's also a high number, but at the same time, they try to keep it uniform. This stuff shows up very well on the graph. And for a company this size, it it is I am aware it is basically an expectation that this is something normal to see. So for me, I would still like to see the company growing in terms of bringing down their debts, and I have concerns now where, their equity growth of itself has started to drop off. If you notice, I have December 2021, which that period is not out yet, but they have released their unaudited fourth quarter, right? So I put that in there. This is that period basically, and then did the calculations accordingly. So pretty much, while everything is in the red, it's still an expectation that for a company this size, this is not something to be overly concerned about, right? Because they're keeping everything steady, they're keeping everything stable as we go on year, right? Additionally, too, I point to their improvements in terms of their 9-month period that has been given here, in that things have actually started to come down in certain respects, right? So we might just be seeing a bit of performance better. And then that's on the quantitative side. All of this is on the number side. But on the qualitative side, and we're going to talk about that later, we can't just look at this and form a conclusion that, oh, it doesn't look good. Because there's projections or prospects on the horizon for them that bode very well. And we'll speak about those later on. Right. So moving forward, we get into now the graphical representation of how these numbers came about in their calculations. So the first two charts that we're going to deal with, the debt to asset ratio and the debt to equity. Now, as I said, normally I like to see that my debt to asset and debt to equity are coming down. Put a trend to this though, is that it would actually be showing, because the highest point was in December of 2016. It would actually be showing that the graph would technically be trending downward. Additionally, too, take into consideration the 9-month period as well too, and it would also be showing that it would be trending downward with respect to how they're managing their debt. The same situation plays out when you move forward. So their debt to earnings before interest, taxation, depreciation, and amortization. In terms of looking at the area that has to do with the yearly financial figures, it's remained pretty much flat. Now, I'm curious to see what's going to happen for the full 2021 year based on how this jumped up, because this is pretty interesting here. So I'll be paying attention to this in terms of how that is handled, because again, paying attention to that means, as the income investor, remember we said the dividend is not coming just from net profit. It is coming from reserves. It is coming from cash. It is coming, as long as they feel that they can make a payment, they are pulling it from various areas. Then we have their debts to their capital, right? Which is basically their equity, not equity, sorry, their, apologies. It would be the particular thing here. One second. The debt to capital would be, I'm trying to remember my particular calculation that it's supposed to be on. 1 second. Just find it back. So the debt to capital ratio, and that is calculating it off of, right, it's equity against the total debt, basically. So the debt to capital, as you can see, again, another level where it would technically be trending down, and especially on the 9 months, it's trending down again. So moving forward, still on the balance sheet, we deal with now cash and current ratios in terms of how they're handling their expenses that are going to be due pretty much, or the ability to pay their expenses that are due within 12 months. And that's basically what the cash ratio.
Okay. 1 sec. Remember, take a full screen, right? Yeah.
So, and that's basically, so cash ratio and the current ratio is basically showing how their ability to handle their expenses on in the 12-month period. So the cash ratio is pretty good. Extremely high in 2020. It is unaudited and tapering off in 2021, but let's see what full report says, because currently for the 9-month 2021 period, it actually went up, right? And then we have the current ratio. So pretty much this is showing that the company on that side of being able to handle that debt, pay those requirements, is doing pretty good, going forward. So we have cash, we have current, and now we come to the part that I really talk about, that I like to focus on. Now, I don't like this, but in the context of the size of the company, again, their debt is really high in comparison to their equity. Could it be better? Well, that's something for us to see what the company does as the years go by. But what that graph of equity versus debt is telling you is that basically equity is you as a shareholder. What is expected, what you can expect to get if the company needs to wrap up or needs to make payments, etc. And as we can see, their debt has really been towering above it, right? So a little bit of concern there. But then we move over to the next chart that shows the overall financial situation, at least on the balance sheet side of the company, which is the assets versus their liabilities. And we can clearly see that year on year, they have been doing their performance accordingly. And they have that firmly where assets, which is what you want to see, is above liabilities, right? And also, it has actually been improving as it had gotten to 2020. Let's see what happens in 2021 when that financial year is put out. And then the last, but this is not the last two. This will be the last one. So second to last two, we have the financial leverage. This is basically another look on their debt part of itself. And if you notice, it's a continuous trend or a common trend that most of their charts revolving around it have the same look where it's basically flat. And it would have a slight trend downward, but it's basically, on a constant. They keep it constant, as it is. When we look at this is the equity growth versus the growth rate of equity. I don't like this chart, because you would want to see the equity growth and the equity growth rate are performing like the December 2019 period, but it's not. It meanders a lot, but you know what? I mean, we have to delve deeper into the company to identify what would have happened to pull this down, basically, at that point in time. And then coming forward for the 9-month period, well, the 9-month period, when you do the calculation, it has that it's trending downward. So we'll have to see when the full year is put out what their equity growth looks like. And then the final part, which is definitely something that is good based on how they're going to pay their dividend, is cash. And as you can clearly see, they have been holding a pretty sizable amount of cash in their balance sheet of itself from since 2019, exponentially more than the other years prior. It is coming down a bit, as you can see the downward slope, but still they are very heavily capitalized in terms of the amount of cash that they're holding. Right. So I wanted to actually just move off for just one quick second. Let me bring up the actual, because I'm going to share this part. I wanted to actually bring up my calculations that were done for them. Just quickly so that we can see what was done. I want to make this bigger. No worries. So with respect to their capital, right, in that figure, in terms of equity growth and equity growth rate, going back to it, I only did show the first part of this snippet basically. But if you look carefully on how their capital is being done, and the capital employed is basically their total assets against their current liabilities, right? How they're putting their capital to work. They've basically kept it on a flat, right? It doesn't meander up and down. From where it's starting in 2014, it's a bit down now well, it's at least down in 2020. But in comparison to their 2019 year, it had really been depleted at that point in time, right? And that also, if you take a look, subject to our link to closely how much their liabilities had jumped up as well too, in terms of that in comparison to assets. So I mean, they've grown, or should I say they've put things to work. But as we go down deeper into the other financial statements, we will find out on this part with respect to the debt, how they are being capitalized. Is it from themselves, or in terms of the actual company's revenue, or is it coming from somewhere else? And that's something to pay keen attention to, right, going forward. So going back to the presentation. We move on now to the income statement. So with respect to the actual money being generated, actual money being made, I've combined again a couple of graphs or a couple of different information from the statements to be put together. So the income statement, we're looking at the revenues, we're looking at the receivables, and we're looking at the revenue comparison to receivables, basically. So revenue is the blue line, the receivables is the orange boxes that are there, and we actually want to see those just where they are. We don't want to see that rising. And then you have the receivables to revenue, which is basically is the gray line that is there. Now notice TransJamaican makes a considerable amount of revenue. Another point to note is that this is against their all of these figures are in USD, right? So there are two stock tickers on TransJamaica primarily that are traded on. There's TJH and TJH US or USD, I believe it is. But their financials are all displayed in US dollars. So for that, I did all of the calculations against their TJH US ticker of itself. So again, going back, we see that they've got pretty good revenue in terms of revenue growth, how it's been trending upward, as you can see on the left graph, going up. There's a bit of a fall off in 2020. And again, the biggest caveat about 2020 was COVID. So they operate the highways. There was a lot of restrictions in terms of movement, not much people basically on the highways, etc., using the highways at that point in time. But still, even though they still managed to keep their revenues up. It's not a precipitous drop off as you can see. Yes, there was a dip, but it could have been possibly like all the way down to 20 million. That didn't really happen. This is just about this is 45 million. Count this as about 45 million that it dropped to from over 50 million, right? And then you have the unaudited 21 period, which says it went right back up. So we're going to look on that closely to see going forward, see how that does. Then on the other side, we have the revenue and comparing that to the total, what we call the enterprise value, which is the amount that the company, if the company was to sell tomorrow, what would the company be worth, taking into consideration its debt, etc. That's basically the enterprise value. Now we can clearly see that the company, based on that, has a really high enterprise value in comparison to their sales and revenue, right? So on my chart, and I'll show it on the sheet when it comes up, I always look at how the enterprise value is in comparison to the market capitalization, because what that tells me is that if the company's enterprise value is less than the market capitalization, in my terms, that's one indicator of being overvalued. Undervalued. If the enterprise value is over the market capitalization, right? One of the things that I look for. So revenue in comparison to EV, well, the revenue is flat, as you can see, but the EV has started to grow again. So we'll see what happens. And then the EV in comparison to sales is trending downward. And I would really like to see that turn in another direction, but we'll see what happens with that. And then, as I said, let me use the right graph first with respect to the market cap, right? In terms of that, as I spoke about that with EV. When I look on market cap, and everybody knows that I like to focus on cash of itself, the free cash flow figure is what I'm looking at. So what the free cash flow figure is basically is the difference between, in its simplest form, is the difference between cash flow from operations and capital expenditure of the company, which is normally property, plant, and equipment, what's spent on property, plant, and equipment. And I like to look on that comparison in terms of if the company's free cash flow is basically either above, on par, or below its market cap. So this, for me, in terms of a company like this, again, once again, shows it doesn't show it shows that the company is overvalued in that indicator alone. And that's another singular indicator for me. But again, as I said, against the backdrop of what this company is supposed to do, you can't take just this alone. Then we move to the revenue. The revenue side now, we can clearly see that I definitely want to see that revenue is moving in or should I say, free cash flow is moving in lockstep with revenue. So I'm a bit disappointed in terms of how low the free cash flow is to the revenue, because pretty much what that is saying is that they've got some high expenses in terms of operating expenses. By the time they get down to their net profit, it's low, pretty much because of that. So, but in terms of the other part of the investor or the income investor, we want to see on this chart with respect to the equity and their return on equity, we want to see that being high. And it is pretty much very stable, as you can see. It would be technically trending downward if we're looking on the actual equity figure, but then the return on equity figure, which is the percentage that is over to the right, is trending up. Now my threshold, and I'll show that when we get there, my threshold is normally for return on equity. I actually like to see 15, but as it stands right now with where it's at, it's just cracked over 5% basically. So they've got some way to go. It was up there before. As you can see, it was above 10, then it dipped back down 2020 due to COVID. But let's see what's happening, because it's on its way back up. It's basically trending back upward. And then we have the return on assets, which basically is what return you get from their assets in terms of the assets that they have. And we can see that it's once again appears to be trending back upward for the 2020 period unaudited. So we'll see what happens when they actually do their full financials that are audited for that year. Then we have, as I said, the net profit. Now, just going quickly back, I did say that when it comes to revenue, if I'm seeing that the revenue is high, but free cash flow is low, then that instructs me that I can also expect that the net profit would also possibly be low, right? And we can see that with respect to that, when we look on the revenue in comparison to the net income slash net profit or net loss, it actually is low, right? So this tells you automatically that if you were to drill into the income statement, that by the time you get down to net income or net profit or loss, whichever one it is, a lot has been taken out of the company in terms of expenses, right? So I want to see this change. I really would want to see this change. And as such, their net margins based on that is also low based on my threshold, that is, right? I actually as well also want to see above 15%. They're below 10% here, but trending upward again. So I think that is something to give them time to see what they do at the end of the financial year. Then we move over to their gross margin. Everybody loves to talk about gross margins based on the fact that it is gross profit at the point of all we're looking at is revenue, and we're deducting what it took to generate that revenue, right? And then forming the gross margin, getting the gross margin calculation from there. So gross margins for the company is extremely high. Very good. But for me, I like to focus on operating margins because that one takes into account how the expenses are being applied. And when you get to the operating margin part, you clearly can see that it's in a completely different picture and a completely different light. It's basically non-existent. And for me personally, that would be something that is concerning. But again, going back to the dividend policy as an income investment company or income investor, the company can pay you from multiple different areas. It does not have to be net profit alone. So you would want to see that gross margins are actually very high. That's actually a positive just because of how the dividend policy is going to be paid, right? Then we have the company growth rate. This is basically what the company growth rate is looking at the revenue, how the revenue has changed year on year. And the revenue growth has been up and down, meandering. But on the unaudited 2021, it seems to be coming back alive. So we'll see what happens when they fully put out the financials for the year of 2021. And then we have on this side, this EG is actually not equity growth, but it's earnings per share, right? So the EPS of the company, and as I said, this figure is based on USD, based on the calculations. Earnings per share, is earnings based on the number of shares against the number of shares that the company has outstanding, right? And the earnings per share for the company had been steadily rising up to 2019, then it dipped in 2020, COVID again, and is now coming back up in 2021. And as you can clearly see, based on the 9 months period, it's starting to come back up. So let's see what they do. With respect to the equity, it's not equity, but earnings per share growth rate, it is just a given that because this has been meandering so much with the earnings per share, you would be seeing a drop off. So let's see if they turn this back around later on. So sticking on this for a bit, let's move to the actual sheet. So I'm gonna stop and come back. So we're back to the sheet again. And this time we move over from the balance sheet, to the income combination of the income statement and the cash flow statement. So let me make this bigger because you definitely need to see this. With respect to free cash flow, as stated, the calculation is basically a difference between these two, which is the cash flow from operations and the capital expenditure. Now, as you notice, this again, US dollars. Notice the way how free cash flow has improved, continues to improve. Then it dips, and then it comes back, and it's improving again. And as we move across to the 9-month period, we see further. Well, this is just 9 months, so we see further improvement. So let's see what the final amount tells us when we get the full 2021. Well, what does that correlate to? That correlates to the graphs that I was showing with respect to free cash flow, which is here. Notice that based on my threshold, even though it shows that it's in a positive light. They are properly they're properly capitalized in terms of having cash on hand with respect to against their revenue that they're making. So my thresholds are good for that one. As I said to you before, the return on equity threshold that I use is not acceptable. It's supposed to be 15. And based on how it was going up and down, it was negative at one point in time. It's now gone back to being positive, at least unaudited when calculated. So let's see what actually happens. But this is the part of the company's ability to continue paying you in terms of return on equity. And then as we look at where the company got its money from, well, as I said, it's not from the revenue, which was up here, because as you can clearly see, the revenue is very small. That's $3 million. Sorry, net profit. Sorry, our net income is very small. That's basically round this up to 4 million US in comparison to a revenue of 52 million, basically, right? So that's being heavily pulled down by their operating expenses that you see here, their admin expenses, so well, that's not that big, but operating expenses, finance costs, those things are pulling them down, right? So if they want to get a handle on that, they really need to do better with respect to bringing up the net profit, right? So yeah, that's basically where they are for the combination of cash and their income statement, cash flow statement and income statement. Additionally, as well too, very important, their cash flow at the end of the year, cash that they have, cash and cash equivalents at the end of the year. Notice that it's actually coming down, right? There's been a decrease. Let's pay attention to this middle line here, where it has been increasing very nicely up to 2019. It has had two steady decreases basically for 2020, unaudited 2021, 9-month period of 2020, 9-month period of 2021. So I look on that. I think, as I said that before, I want to see healthy cash flow, which it's currently on a downward, and I have concerns about that basically at the end. But they still have positive cash at the end of the day, and their free cash flow to sales is still positive. As we looked on the gross margins, we spoke about that, basically where the dividends could be coming from, payments could be coming from. It's not coming from net profit alone. They have high gross margins, so that's really good. They have they had a low operating margin, but they've gone positive in 2021 unaudited so far. So let's see what happens when the audited financials come out, right? So pretty much, yeah, that's the company in terms of the income statement. Now let's take a look at where they actually paid that last dividend from. I promised to make reference to it because it's very important. At least to me, it was very important. So let me bring up the screen for that. We're going to have to use their financials.
GK, one sec. Somebody was asking, Paper Plate is asking, what is it in their operating expenses that's dragging down their revenue that much?
Good stuff. Well, we're going to get to that in short order because that's going to be seen when we look on the company financials. So this is 2020. And in their operating expenses, let us take a look now. So in their operating expenses, I'm going to zoom in so that everyone can see. In order to look on that, we have to take a look on note 20, right? In which it was a total of $31 million being taken out. And prior to that, $36 million taken out. So let's look on what really drags that down. So note 20, it's going to be a quick scroll. And this is why it's, again, very important to read notes, everyone, because it informs where things are coming out from. So let's go. So here we have operating expenses and the line items that make up their operating expenses, basically. So the highest line item for both sections that we can see, there are two that stand out to me immediately. Operators' fixed fees and their amortization of their intangible assets, which this basically is, if I'm understanding it correctly, is basically a write-off of itself. So, I mean, those two were taken out to be done. So those are the two main ones that are there. Other ones are pretty much minuscule, you know, repairs and maintenance, which is what they have to do on the roads of itself, and their insurance that they need to pay. Those are pretty small, but the big ticket items were coming out from operator fixed fees and amortization. Let's check. This is 2019, 2020. Let's check that's the annual report. I'm going to go into, let's see if we have any audited financials prior to that. No, actually, let's use their IPO prospectus, because that would inform the years before. And it's always good, everyone, to basically refer to the information. As I said, I like this company for review just because I had information that I could refer uh, to make sure that, you know, is the company keeping up with what they're doing, etc. So this is their IPO or their prospectus of itself, and specifically the page that they gave company financials on. Have I gone too far? 1 second. We actually got a chance to see. So that's the company financials in terms of operating expenses in 2018. That's what I'm looking for now. I'm looking for how they mapped out, how they matched up in 2018. Because again, here we have this is a 9-month period, and that's on note 17. So let's look and see if it's the same thing that's happening. So note 17, too far. Here we go again. So note 17, once again, we have high operator fees and amortization. So it seems to be the common trend for them so far, as we've seen coming forward. So that's 3 years already. That is the same thing. And if we look on the particular financials for the quarter, right? For the quarter, which was 2021, it should be the same trend that we see again. Where we look on the revenue, the operating expense. Oh, we don't have it in this one. We just have to look on the notes. Let's see if it's in the operating expenses. If I can find it in the notes. Here we go. Once again, same thing. Operator fixed fees, amortization. So I believe that should answer the question of what is the biggest thing that is driving them down, basically, in terms of driving down that net profit number at the point in time, right? So moving forward, right? So how often do they pay dividends? All right, so we'll get to that. So their dividends, and again, that is informed in the start of the presentation what they were supposed to be paying. So at least annually, you're supposed to get a dividend. So it could be that you get 2 dividends, but if I'm correct, let's look on how they had paid dividends based on GSE and the info. So GSE info has that they paid dividends, 1 second. And this is, you can actually look that up right here. So this is the US version, so we can look on that one. I believe it's on the Jamaican version. Let's see, TJH. There we go. That's earnings. And these are the dividends. So the total number of dividends that were paid. So we have 2020 and 2021. So it's one dividend you're getting per year, basically. And this is in Jamaican dollars, as you can see, it was converted into Jamaican dollars. So with that, I was going to pull back the presentation to the next part is dealing with the actual price and volume. But I think based on the fact that when I took this information, it was yesterday, let's look on a more updated set of information for them. And we're going to look on both tickers, both the USD and the GMD. So one second. So this is today. And as we can see, the price has pretty much, it's in the last 3 months. This is the last 3 months chart. The price has started to actually move back up a little bit, right? So there must be some anticipation about something about to happen based on when they're coming out. So let's see. Is it going to be when they're going to put out their financials? We do have dividend payments being announced, but this is for preference shares. Then we have, but we don't have any audited financials. When was the last audited financials put out? Let's see. So we can get a gauge of when it might be coming out. Audited financials was in March. So more than likely, you're not going to see the audited financials for the year until the end of March anyway. And we've already gotten the quarterly financials already. So something else would be up about why the price has started to rise again, right? As we can also see, the company has healthy volume every single day. And if you drill down into this chart into the 1 month period, you notice that this amount is basically, what is that, 3 million units? Before that, it's 1 million. So every day, what I've noticed about TransJamaican is that they have a healthy volume of trading going on above 1 million units. So as I said, for me, it informs to me that as the company just performs, I don't expect that the stock price, I won't be looking to see the stock price moving like that unless they're paying a much bigger dividend, right? And that stuff like that normally informs the stock price. And then there's other stuff as well too. The company makes some kind of gets some kind of additional money that is there. And that's what I wanted to bring up, that I saw for their last dividend, how it was paid. So with respect to how their dividend was paid, let's use their annual report as for 2020. It will inform much better. And we're gonna go down to a particular thing that happened with respect to their payment. So when you want to know about the dividend payment that has been done, all you need to do is look at the statement of changes in equity on that section. So basically, if you look at 2019 period, right, they didn't pay a dividend in that period. This is the start of it, this is the end of it. Then we have in 2020, we have a dividend being paid for the 2020 period. Additionally, if you look back on the prospectus, and this is basically your homework, go and look back on the prospectus of TransJamaican, you'll notice that other dividends weren't paid in the years before either. But what happened this time around that allowed them to pay the dividend? Well, when we looked at the company in terms of the annual report, we noticed that the company made for 2020, they made a loss. So where is this dividend coming from if they made a loss, right? In terms of how much was paid. The dividend was coming out of this that was done. So apparently they got a grant, which is basically debt. Let me show you in the cash flow statement. So in the cash flow statement, this is why I say it's very important to look and identify where money is flowing through the company. So in the cash flow statement comprises 3 sections: cash flow from operations, cash flow from investing and cash flow from financing. In the investment section is basically where you would see everything that they're buying in terms of property, plant, and equipment or any other outside investments not related to operations. In the financing section is where you're going to see them paying off their debt or getting money. So with respect to their cash flow and that particular year of 2020, we notice if we focus on their cash flow from investing, there's nothing really going on inside there. But in their cash flow from financing, right, we see proceeds from borrowings, right, of 216,921. And then we see the dividends being paid. So you're going to wonder, you should immediately ask, where did the money come from? Then there's another proceeds of borrowings the year before. If the money is being paid, if a dividend is being paid and it's negative net profit, then it's got to be coming out from something that some money that they borrowed accordingly. So pretty much when they got that grant, which is up here, the asset section, we go to the assets. It's here in borrowings, says item number 15. Let's look on that. Item number 15 that says borrowings. Item 15. Not it yet? No, not yet. Where is that grant? Long-term financing debit notes. Is that it? Looks like it. Note number 15C. For 2020, we got $220,923. 20, right? So 923,000. Apologies, right? So on that, after they paid out whatever liabilities they needed to do, they then paid their dividend. So as I said, accordingly, they can take their money because it's not explicit to net profit. They can take their money from anywhere. And the biggest recipient of that dividend, as I said, with respect to top 10 shareholders, which is very important. Let's look on that. That's preference shares. Top 10 shareholders in Rock. 2.5 billion shares. 20% holding in the company. So at the end of the day, my question about TJH is, if the company is not making money like that, how is the dividend going to be sustained? Because so far it's been paid out of the grant that has been given, the borrowings that have been given, right? And basically, as we look on the company of itself, we see that, let me go back to that. Apologies if I'm moving a bit fast on the screen. But when we look on the company itself, focusing on the revenue, the revenue basically is small, right? I mean, in terms, sorry, not revenue, but it's whatever its net profit is or its net losses, etc. So if a company is not generating, and more so their cash flow from operations, right? Their cash flow from operations it was going down, as you can see. So focusing on that, you have to always ask, where is the money coming from to continuously pay that debt, pay that dividend. So those were some of the questions that I had with respect to consistency and the ability to continue paying the dividends. So we'll see what happens for the 2022 period in terms of being able to pick up. They've still got money, by the way, as you can clearly see, they still got cash. So let's see where it comes from this time when they pay their next dividend, right? So moving forward from there, we go back to what their stock price is saying, or what their stock price looks like. And as we see in the general day-to-day functionality of the stock price, that is with respect to the local one, TJH of itself, we note that it has movement. It moves. So let's do the 1 year. No, we were as high as 1.4, and that was in March of last year. This is 1 year on, pretty much. It's now moving back up again, but we were as high as 1.3. Let's see what happens if it can get back to 1.4. Who knows? But as we clearly see, when we zoom into the chart, we notice that there's constant volume that goes through the company every single day, right? So, I mean, want to look at to delve in a bit deeper.
The volumes are typically usually good. I noticed right around end of month. So
What happens in the month?
Well, my take is maybe it's like either some pension funds or long-term funds purchasing. It's usually some good volumes at the end of the month. If you notice it.
Well, we don't have to guess indeed. It's right there. So if we go, let's go 6-month chart and look at the biggest spikes. That's the 31st of January. This is the 17th. This is the 23rd of February. The one before that is the 22nd of December, close to end of the month again. This one here is again November 22nd. Yeah, there's definitely merit in that. Yeah, definitely merit in that. But that also means to those listening, that also means that you realize that for you to move the stock price because there is large supply, it's going to be a bit difficult to move that stock price up if that's what you're looking for. Because immediately as the supply, as you put up a bid, the supply is going to come in and try to and basically push the price back down in that way because there's a lot of supply there, to meet that.
It depends. Depends because remember, it doesn't take a lot of volume to move the price anymore because you can buy one share. So it depends, right? Look at no, I don't want to mention a company.
You can't. But the thing is, as I said, the comparison is simply this: any other company is smaller in terms of volume. They don't have they're not moving. They're not necessarily possibly moving a million shares every single day, right? So it's much smaller. So pretty much.
I like high volume stocks.
Yeah. Yes, I do. I definitely do. For all those who are listening, that's Jermaine on the side, definitely. But then moving over though, it's another completely different picture when we look on the company with respect to their USD side. That side now, the USD side of TransJamaica, that really doesn't move that much. As a matter of fact, it has been trending downwards. So whereas one graph is trending up, the other one is trending down with respect. And the volumes on the USD side must be something about that is not as consistent or even high as what happens on the Jamaican side, right? So notice it's flat, it's really small, And truth be told, what is this? 0.01 at the growing exchange rate. Let me bring up a thing. So 0.01, let's use the higher part of the exchange rate, which is I guess 158. It's a point times 158. That's about $1.58 per unit. Well, okay. We're trading TransJamaica currently on the Jamaican side at $1.20 odd. So yeah, I can understand why people would not gravitate to the USD side more. But the thing is, with things like the US dollar going up, etc., and so forth, or if the US dollar continues to go up, then buying TransJamaica at a lower price bodes well for you when it starts to go. But I mean, taking everything into context of what it is, the USD side does not play the same way as the GMD side, and the volumes are much smaller, right? So pretty much with that, where are we at now? So we're at basically what to look out for with the company and going forward. Well, with respect to that, we have the news that they've had. So in the JSE, we know we have the stuff coming out, the reports are due, etc. But what, in terms of things to look out for, is not going to be seen on the JSE. You actually have to go into the actual news of TransJamaica. So with that being said, at that point, if everyone knows, we have a highway extension being done. What is it, from Williamsfield to Maypen to Williamsfield? Is it that is being done? And then everything that happens thereafter We have also some other things going up as well too on that highway. I just saw when I read the news, there is a total gas station that is supposed to be going up on that highway leg as well to that east-west leg. So there is activity happening, and additionally too, with the relaxation of the current restrictions, more activity moving from Kingston, or should I say, moving across the island from east to west, etc., which means more traffic. There's something I want to point out in that as well too, with respect to what I noticed in their financials. What I liked about it is that they actually give their breakdown of where the revenue is coming from. So again, pay attention to that annual report because it's not all pretty pictures and it's not just numbers alone. The qualitative side is informed as well too. Here we have this is their income, right? And we're looking at their traffic by each toll plaza. Now notice a picture that has developed. As I said, I couldn't remember Spanish Town. So it's Spanish Town, Vineyards, and Maypen, right? Then you have the Portmore leg. Now the Portmore leg is high density based on everybody trying to get over to Portmore, and as you can clearly see, it's their highest traffic. But pay keen attention to how these change, the other three change going forward when the Williamsfield, the Maypen leg, Maypen to Williamsfield leg is completed. Also pay attention to what their highest revenue class is as well too, in terms of who generates the most, right? If you have a thought process that based on when, sorry, the highway is completed, we know that we have a boom in real estate going on. If it is that there's going to be many persons based on the whole work from home, and personally, I don't foresee that we will go back to everybody goes back to the office. I believe that hybrid thing is technically as best as possible here to stay. But then it is about the percentage of the country that is able to do work from home, which was actually a small percentage as we are aware of. So if persons can't take the congestion and the highway is completely done, and it takes about what 30 minutes to get from Mandeville now into Kingston. Actually, it's not 30 minutes because I know it's about 40 minutes to get from Macon to Kingston. But still, it is much longer to Mandeville without the highway, right? If you now cut that down by a whole half an hour, and it is more feasible for persons to find better housing in the environs around Manchester, etc., look for the uptick to see in these other three plazas. Well, not Spanish Town one, but in terms of Vineyards and Maypen, because these are the two tolls that you must pass through on your way to get to Manchester, Mandeville, etc. Right? So there should be, and I won't say should. I'd be looking for an uptick as traffic moves outward, or as more traffic, more economic commerce, etc. moves using this leg of the highway to get to Negril, etc. and so forth. You know, I would expect that this would be upticking more. But as you can clearly see right now, their biggest revenue earner is Portmore. There's also something you must also remember that the company is allowed to basically do a review every single year to ensure that they are meeting their targets and they're allowed to increase their fees, subject, of course, to the regulators allowing them to do so. But normally they get it. They get their fee reviews, not exactly how they want, but they normally get their reviews, which just means that as their fees increase, if user base increases as well too, then revenue by right should be going up even more, which means gross margins will also be going up even more. Let me see if there were any other charts that are here. So here you had traffic by toll plaza, which was Portmore is the biggest traffic, but look on the revenue by toll plaza. Revenue by toll plaza, Vineyards is challenging Portmore, right? In terms of that uptick coming up there. So what do we have out there? I believe we have Old Harbor, New Harbor. We have places that are out on that leg basically. That persons are migrating from Kingston to because the roadway is available there. As the build out continues, pay attention to this. And more importantly, as we beckon back to the dividend policy, and the fact that between 2020 to 2025, it's supposed to be anywhere between 5% to 8%. We want to see that consistently being given, which brings us to the point of actually that same dividend policy. Let's do a calculation. And if you bought TransJamaican at their rate of, let's say, when the last dividend, so the last dividend was paid. So basically the price has stayed stable. So this is 0.0865, right? And we're going to do dividend yield is the most important thing, not price, in my opinion. Looking at the price of how much you were paid in the dividend is not the thing. It's about the dividend yield and how much you actually got. So let's see what dividend yield you got at a price of 124 for this dividend last year in 2021. So that is 0.0865. You divide that by 1.24 and you times that by 100%, and I get myself a 6.975. I'm going to round this up, a 7% dividend yield. So we are at 2021. Their period between 2020 to 2025 said that they're supposed to pay you between 5.3, was it, to 8.7, and I got a 7% dividend yield. The year before that, in 2020, right? Let's go 2020, and I mean the stock price was a bit higher. We have 2020. No, we only have up to 2021. Let's take that the stock price was still anywhere between an average of 130. I'm going to put it as 130 then, right? And that payout was 0.0748. So 0.0748. I'm going to divide that by 130 this time instead. 1.30. Still end up with a dividend yield of 5.8%. So you can hold them to account that they've actually been performing as they stated they're supposed to be doing in their prospectus, right? So with that being said, I'm going to open up, I'm going to go back to looking at the question. So we have one, let me see that back again. Fees on the vineyard are higher, too, hence more revenue. There you go. And if more people use vineyards, expect that vineyards, that's true, expect that vineyards revenue would then possibly surpass Portmore in some order, especially if there's a big boom of persons moving outward to that section, moving out to the west, right? Based on the highway being there. Yeah. So we'll see how it goes. Well, I've actually learned, Paul, this is a good one. I've actually learned that even though there's heavy traffic, there was the other thing as well. If you remember, there are times when the Portmore highway is plagued with, the toll is plagued with things happening where, persons using it and then, something breaks or they can't have, some people get through because payments can't be done or, cash or something like that. So it's all about efficiency. If they are taking off all of the users, and I would actually want to see now a comparison of Portmore heavy traffic and see what that comparison is on the traffic side, what change has happened in terms of a graph, in terms of the traffic graph. And I'll tell you why. So I'll show you the prospectus again, because I'm pretty sure it can be seen in somewhere in the found in the financial statements of itself. So let me bring up the window that has the prospectus again that I was looking on. 1 second, and I'll show you what I mean when I'm speaking about that. Where is it? There we go. Right. So in the prospectus, as we're looking on it, go up to the very top, and we look on the charts that they had actually drawn for us. They had given for us. Right, you have all of the toll plazas. They were breaking everything down very nicely in terms of which plaza does what and so forth. But what you had as well too was traffic. classes, etc. I think there we go. This is what I wanted to see. Look on the years of the historical traffic for each. So let's focus on Portmore. That's blue. And we look on 07, 08, 09, right up to 2019. I'd love to see what happened in 2020. I'd love to see this chart in terms of what happened in 2020. And now I'd love to see what happened in 2021. So just by saying that, oh, we're back at seeing, high traffic again, relative to what? That is the question I would ask. Or relative to what period would be the question that I would be asking, right? So let's see if we have any other questions. Did I do any analysis background on any other tool company similar to TransJamaican? Well, no, I didn't, to be very honest. In terms of, and that's what I was saying originally. When you look on the balance sheet information, you notice that it's across the board. Unfortunately, and you're absolutely right about this, it should have been done, but then who would be compared to? So we'd have to be looking at a company, for instance, in another country, like where there are other places. Would I want to use the United States? I'd more like want to use UK, right? In terms of us being maybe a bit more closer to us to see. But as I said, in looking on how the balance sheet is set, our balance sheet ratios is set up, I think basically it's an expectation that this is just how the company performs, right? And it's consistent across the board. My thing is, at the end of the day, if the company can improve their operating expenses, etc., so that it's not dragging out a lot of money from revenue, we can see across the board a better financial position as it improves, not just in cash, but I would like to see less borrowing being done, because less borrowing would mean that they're on their own with their operations. They're standing on their own very well, right? Right. So I think we've got it covered. And of course, all of the information, as you've clearly seen, basically I've found a lot of them on the Jamaica Stock Exchange. Everything you need is on the Jamaica Stock Exchange, to be honest. And also you can find the prospectus there as well. So if you
Yeah, we'll put the links in the description.
Yeah. So, but I don't have that. There's one more message here: the impact of the Bernard Lodge development for this. Well, the Bernard Lodge development is a speculation, in my opinion. But again, it's a positive. If there's complete uptake of every single house being offered, or dwelling, I want to use, being offered there, right? To get to Kingston, if everybody's working in Kingston or the environs, they have to use the road. Well, they could use the old road, but the easier, convenient, less wear and tear on your car, etc., less gas being burned, especially with high gas prices currently, is to use the toll road. So an expectation could be that once the Bernard Lodge development is completed, there is going to be more usership of that leg.
Yeah, I think that's it. I think that's all the questions. All right. So, Chike, yeah, I think we've covered everything, guys. If you have any questions upon watching the review, place it in the comments below. If you are interested in, seeing more information, maybe there's a piece of information you're looking for that we didn't cover. We do try to cover everything that you could possibly need, and that's why it's so long, almost 90 minutes, because we cover everything. But let us know just in case there's something else that you'd like to see. And yeah, so a lot more content coming out this week, so stay tuned for that. We are going to be doing a review on the fact that JFP has closed. We have Edifocal IPO to look at.
IPO, yep.
We have a Building Wealth on Sunday, I believe it is, with David Mullings.
It is Sunday.
And we
that's before before you go any further, everyone, you genuinely should tune into that, because the last time David was on, he he gave great insight, dropped great gems, and it was a very interpersonal discussion that was well received. Right, you shouldn't miss that one. It's not all about the numbers, as we say. Sometimes it's about the quality that is there. You get great insights, especially from persons like David who run their own company, coming to tell you how the strategy is very simple in terms of creating generational wealth. It's not no convoluted, complicated formula, to be very honest. So definitely tune in for that one.
I'm looking forward to what David will share. We're just gonna take one final question. Let me see which one to share here. That one from Stefan.
Yeah, that actually is good. That's a good. That's you see, that's the kind of things in truth. Yes, it would be. You would want to expect it to happen. That's the question. Will it actually occur? And that is a good question. You'd have to look to see as digital payments. They actually do. I remember seeing that though, that they've been doing heavy advertising and making sure to let persons know, especially with the use of their tag card. If you do X amount of ride uses, you get a trip free, etc. That would come in very handy for, as you can clearly see, class one was the biggest amount, in terms of traffic and so forth. That would come in very handy for all those where gas prices are going up and using the traffic, the highway. Sorry, if you know anything about it, you burn less gas actually on the highway because you're supposed to be at a constant speed, right? And you can go on the highway at 110 kilometers an hour. That's basically the maximum speed. If you keep a constant speed, then you burn gas very evenly. If your car is in tip-top shape, your tires are in good shape, etc. So, with that being said, if they're doing good offerings with their digital payments, if the system works well, right, all things being considered, yes, they should be ensuring to capture that revenue without having any mishaps where persons have to go through because the tag is not working. Well, not the tag is already there. But when persons have to pay, they can't pay because whatever medium is not working, kind of thing. So yeah.
And I think the point is comment as well about operational efficiencies. I guess seeing benefits on that side, not just for revenue but overall operational costs, etc.
Yeah.
I think that's where I was going with it as well. All right. Thanks, GK. Thanks everyone for being here. Please remember to like the video. It's very important. Share this channel with somebody who you are encouraging to start investing. And we will see you in the next video.
Take care, everyone.
Bye.